And this is the agenda for this afternoon, which is really what is CRS all about and how it impacts. What is the implication for high net worth individuals? And then what are the issues you should think about when you're doing a private wealth structure? And my colleague Kathy will then touch on setting up a family office. Alright, so the Common Reporting Standard, you may or may not have heard about it, but essentially it's a global standard that has, it really refers to the exchange of information between tax authorities on an automatic basis. And this information relates to financial account information. And this started, this is an OECD initiative, and it started with FATCA, the US FATCA, and then it's graduated to the OECD CRS. And essentially, it is a game changer for the whole tax industry. All right, because what it is it applies automatically. So in other words, tax authorities, if you're talking about Singapore and Malaysia, Singapore tax authorities will share information with Malaysia once they sign the bilateral competent authority agreement on an automatically on an annual basis, relating to financial account information. All right, so essentially how it works is that because the information that is shared relates to financial account information, banks in Singapore, so we'll use that as a scenario so it's a lot easier to conceptualize. Singapore banks, where the account holders are Malaysian residents, all right, those accounts are what we call reportable accounts. All right, so Singapore authorities, Singapore banks will have to report information on those accounts to the Singapore tax authorities, who will then share that information with Malaysian tax authorities. So you're really looking at the account of the bank, right? And who are the account holders? If the account holders are non-resident, all right, so in this case, let's assume they are non-resident, they are Malaysian resident, then information on that account will be shared with Malaysian tax authorities. So they will have information on the account. What information are we talking about? It's your account balance, all right, and all the transactions in that account, all the income that is accredited to that account, or any proceeds from the sale of assets which are credited to that account. All right, so that's how it works. In terms of the countries that have agreed to implement CRS, like I said, this is a global phenomenon, and 102 countries have agreed to implement, including Malaysia, Singapore, Australia, all the tax havens, even the like BVI, Cayman Islands, where we normally set in the past, a lot of high net worth individuals will set up entities in these tax havens to hold assets. Right? These countries have all agreed to implement CRS. All right, so there'll be sharing of information. So in terms of how does it work for a high net worth individual who has set up a trust structure, or because a lot of them do look at trust structures for succession planning, and or you are looking to establish a trust structure. How does that work? Is there reporting in that case? And the answer is yes. All right. So how is a trust structure, trust viewed under the new regime? All right. It can be viewed in two ways. It can either be treated as a financial institution. In other words, your trust that you've set up can be treated as a reporting financial institution, which means it has an obligation to report on their account holders. And who are the account holders? It would be the settlors, the beneficiaries, and any other person who has interest or who exercises control over the trust. All right, so, and who does the reporting? It's not actually the trust, but it would be the trustee who does that reporting on behalf of the trust. All right, so you could be a financial institution. But as I will talk about it in a little while, in terms of the information that is reported, is a lot less than if you were to be treated, the trust were to be treated as a non-financial entity, NFE. That's called a non-financial entity. All right, so the reporting information that is shared is a lot more extensive if the trust is treated as a non-financial entity. All right, so what is a trust? Okay, so is it a financial entity or a non-financial entity? This is the slide to tell, I've talked about it, what is the information that's shared. But let me look at let's go through the case studies, because that will give you an idea of how this process works. So this is the base case, all right, the base case of where you have a Malaysian individual who wants to invest, all right, he sets up and he wants to invest through a BVI company, all right, he invests in real estate, it can be in any country, equities, again in any countries, US equities, and then he opens a bank account in Singapore, all right? BVI, Malaysia, and Singapore have all agreed to share information under CRS. So what it means is that the Singapore financial institution, which has an obligation to report, all right, will look to see who is the account holder. In this case, the account holder is the BVI company, all right? It's a non-resident. So and plus, because it's just a pure shell, right? It's an investment holding company. It's what you call a passive non-financial entity. The bank will have to look through to find out who the controlling persons are. In this case, the controlling person is a Malaysian, a Singapore non-resident, BVI non-resident. So the Singapore financial institution through the Singapore tax authorities will report information to the BVI tax authorities, all right, on the account, as well as to the Malaysian tax authorities on the account. So the settlor's bank account information, although it's in the name of the BVI entity, will be known to the tax authorities back in Malaysia. Okay, so this is the base case. What if you have a trust in your structure? Okay, remember I mentioned earlier, your trust that you have set up can either be a passive non-financial entity, in which case what will happen? The reporting institution will have to report on that account, will look through to determine who the controlling persons are of that account. All right, the account is in the name of this entity, which is passive. They will look through, say if it's POS, look through to determine who is the controlling person, and if it's a Malaysian resident, which is the non-Singapore resident, because your account is in Singapore, then there will be reporting to be done. So how does it work here? You have a Malaysian settlor who has beneficiaries in Australia, who set up a trust, all right, and the trust is treated as a passive non-financial entity. And generally you're treated as passive non-financial entity if you're not professionally managed by a trustee company, or you're set up in a jurisdiction that is non-participating, in other words, not participating in CRS. Then you're treated as passive non-financial entity. All right, so what happens here is that Singapore Bank, the trust has an account in Singapore. Singapore Bank will have to look through the trust, all right, who are the controlling persons, whether or not they are actually controlling the assets in the trust. The settlor, beneficiaries, protectors, trustees, and any other person who controls the account will be regarded as controlling persons and therefore reportable persons if they are non-resident in Singapore. All right, they will be. So even if you have a case where a settlor has created a trust, which is a discretionary trust, in which he has no interest, in other words, it's irrevocable, he's not a beneficiary, he's not one of the beneficiaries, so he has no interest. He's given up control, all right? The settlor will be reported, all right, back in Malaysia, and he'll be reported on the full value of the trust fund under this structure, the passive NFE structure, where the trust doesn't qualify as a reporting financial institution. So you will be reported. Beneficiaries will also be reported if they are fixed interest beneficiaries. Discretionary beneficiaries, the position has been taken by Singapore at least, I'm not sure what is the position in Malaysia, that they will enjoy the same treatment as when a trust is treated as a financial institution. So essentially for discretionary beneficiaries, you are only reported in the year you receive a distribution. For a settlor, you're reported on the full account value, even if you have no longer any interest in the trust. All right, so the reporting is done in Australia here, in this case, because the beneficiaries are there, in Malaysia. So information on the account or the trust, the assets of the trust are shared with the tax authorities. Now we move to a case study where you have a trust that is treated as a reporting financial institution. So like I mentioned earlier, not sure whether you caught it, in fact this is a better scenario for high net worth individuals, alright? And so and you're treated generally as a reporting institution, reporting financial institution, if you're professionally managed by a trustee company. Alright, so what is the report? It's not that no reporting will be done, reporting will be done, but for the set law, if you create an irrevocable trust, you are not one of the beneficiaries, the reporting that is done, there will be reporting, but a nil value is reported back to Malaysia. For the beneficiaries, as long as you're a discretionary beneficiary, you'll be only, the reporting is only in respect of what you receive from the trust in the year you receive it. Alright, so very simple, minimal reporting under this structure. So when you're looking at your trust structure, you should try to move towards a structure that gives you a classification as a reporting financial institution, which means managed by a professional trustee. Alright? Do not set it up in a non-participating jurisdiction. Alright, that is not participating in CRS, because if you set it up, it's professionally managed, but you set it up in a country thinking that if I set it up in a country which doesn't subscribe to CRS, I'm safe. The answer is no, because the Singapore institution here, bank, will treat it as a passive non-financial entity and look through and do the reporting on this basis where the full value is disclosed. Alright, so touching on that. So what are the implications for high net worth individuals going forward? Obviously, a lot of information is going to be shared between tax authorities. So they're going to be inundated with a lot of information. They will have to have the technology in place to be able to decipher what are high risk areas for the taxpayer, right? Or for themselves, right? To determine whether there's been any non-disclosure or under-reporting. Alright, so for the taxpayer's point of view, what do you need to ensure? You need to ensure that your reporting is done accurately and your record keeping is scrupulous. Alright, and whatever structures that you have in place, that there is substance. Alright, preferably the move should be towards a simpler structure, because the fewer layers you have in your structure, your reporting obligations are reduced, right? If you have more complicated structures, you're going to have very, very extensive reporting obligations. So that should be the move going forward. In terms of your trust structures, move towards a discretionary structure as opposed to a fixed income interest structure. Set law interested structures may not be very viable in this day and age. So what does that mean? Does it mean that as a patriot you have to give up all your assets? No, you can ring fence your assets. What you need for your needs, right? For your own financial needs, etc. Ring fence that. What you're prepared to give up control of, put that into a trust. Have no interest in that trust. Alright? Create an irrevocable trust. Then the reporting is minimized. Okay, and then of course, like I said, there are other ways out. For example, I did mention that for a passive NFE, it's a look-through. Okay, look-through meaning the financial institution will have to determine your controlling persons. But think about setting up an active non-financial entity, because for an active non-financial entity, if that is in your structure, there is no look-through. There is reporting, but no look-through. Alright, active. What is an active NFE? Essentially listed companies. Alright, for example, you have a Malaysian listed company. In fact, it's excluded, it's an excluded entity. But let's say you have a Malaysian trading company with a bank account here. Alright, does that mean your shareholders will be reported back home? The answer, or for example, you have a UK company with Malaysian shareholders which has an account in Singapore. Does it mean that the Malaysian shareholders will be reported back home? The answer is no, because it is an active entity, meaning it's got an active business. So the reporting stops there. There will only be, it's a UK entity, reporting is only done to the UK tax authorities. There is no look-through. So how do you set up an active entity? Very easy. It can be, have a business. It can be a holding company of your stable of active companies. It can be a holding company, and that would still qualify as an active entity. Alright? So, or it can serve as a treasury center for your group of companies. All right, so for example, let me give you an example of, for example, if you set up a company in Singapore, all right, and it's an active, it's a holding company for your Malaysian active businesses, all right, so it's a holding company, and that will be treated as an active entity. There is no need to look through, so no reporting is done back home in Malaysia, but just of the controlling persons. All right, and if the active NFE is set up in Singapore, is there any reporting? You have an active NFE with a Singapore bank account. The active company is a Singapore company. There is no reporting at all. So if just to go back, in case you're not clear, Singapore holding company of your Malaysian trading entities, you set up a Singapore company, all right, which then has a Singapore bank account, okay. There is no reporting because the account holder is Singapore resident. All right. Do you need to look through to determine the controlling person? The answer is no, because that entity is treated as active and not passive. All right. Whereas if you set up a company in Singapore and it just holds passive as investments, all right, then it's not treated as an active entity. You need to do look through, all right, to determine who the controlling persons are. So these are all the issues relating to whether I get reported, if I get reported, what is the information that is shared, and yeah, the rules around this are a little complicated, but I think if you think through it and get proper advice, you can structure it properly to minimize reporting. Okay. This is just a slide on really when you look at a structure or a wealth structure, it's not just tax, all these tax issues you need to consider, but you've also got to consider what are my reporting obligations. In the past, when we advise clients on a private wealth structure, we're only looking at tax. Now it's no longer enough, right? We have to advise the client on what their reporting obligations are. Not obligations because they don't report, but they need to understand what information is being shared, all right, and they need to prepare for that.